Module 2. Adjusting Entries. Allowance Method to account for uncollectible accounts. The allowance method is a commonly used accounting method for estimating and recording uncollectible accounts. It is a method used to estimate the number of accounts receivable that a company expects to be uncollectible, and it records the estimated amount as a contra-asset account called the allowance for doubtful accounts. Here are the steps to account for uncollectible accounts using the allowance method. 1. Estimate the percentage of accounts receivable that are expected to be uncollectible. This can be based on experience, industry standards, or other factors. 2. Calculate the estimated amount of uncollectible accounts by multiplying the estimated percentage by the total accounts receivable balance. 3. Record the estimated amount of uncollectible accounts as a contra-asset account called the allowance for doubtful accounts. This account is subtracted from accounts receivable on the balance sheet. 4. When an account is deemed uncollectible, record the write-off by reducing the accounts receivable and the allowance for doubtful accounts by the write-off amount. 5. If the estimate of the allowance for doubtful accounts is too high or too low, adjust it accordingly by making an adjusting entry. 6. The allowance method ensures that a company's financial statements reflect a realistic estimate of the collectibility of accounts receivable. By estimating and recording uncollectible accounts, a company can more accurately report its financial position and performance to stakeholders. For example, a company uses the allowance method to account for uncollectible accounts. Its year-end unadjusted trial balance shows accounts receivable of $104,500, allowance for doubtful accounts of $665, credit, and sales of $925,000. The uncollectible accounts are estimated to be 0.5% of sales. Calculate the estimated amount of uncollectible accounts based on sales. $925,000 times 0.5% equals $4,625. Inadequate useful life of an asset. The inadequate helpful life of an asset refers to a situation where an asset becomes obsolete or unusable before its expected useful life has elapsed. This can occur due to various reasons, such as technological advancements, changes in market demand, wear and tear, or poor maintenance practices. For example, a computer system purchased by a company may have an expected useful life of 5 years. However, if technological advancements make the system outdated and unable to support current software programs after only 3 years, the asset's useful life would be considered inadequate. Inadequate useful life can have significant financial implications for a company or individual. It can result in unexpected expenses for repairing or replacing the asset, decreased productivity or revenue, and even impact the organization's overall financial health. The need for more capacity of a company's plant assets to meet the company's growing production demands is a component of inadequacy. To mitigate the risks of inadequate helpful life, it is crucial to conduct proper due diligence before purchasing an asset, regularly maintain and update the asset, and consider future changes in the market and technology that may affect the asset's usefulness. Changing the useful life of an asset. The useful life of an asset is determined based on various factors such as expected usage, wear and tear, technological advancements, and market demand. However, changing an asset's useful life is possible if any of these factors significantly impact the asset's expected lifespan. Changing the useful life of an asset can have significant financial implications, particularly in terms of depreciation. Depreciation is the method used to allocate the asset's cost over its useful life. When the useful life of an asset is changed, it can impact the rate at which depreciation is taken, which can affect the financial statements and tax liabilities. To change the useful life of an asset, it is crucial to thoroughly analyze its current condition, expected usage, technological advancements, and market demand. This analysis should consider qualitative and quantitative factors and involve input from relevant stakeholders such as engineers, technicians, and financial experts. Once the analysis is complete, the new useful life of the asset can be determined, and any necessary adjustments can be made to the depreciation schedule. It is important to note that changing the useful life of an asset may require approval from regulatory bodies or tax authorities, and it is crucial to comply with any relevant regulations or guidelines. For example, say a machine initially had an estimated useful life of 6 years, but after 4 whole years, it was decided that the original estimate of useful life should have been 10 years. At that point, the remaining cost to be depreciated should be allocated over the remaining 6 years. Benefits of accelerated depreciation methods. Accelerated depreciation methods are depreciation methods that allow businesses to write off the cost of their assets at a faster rate than traditional straight-line depreciation. Accelerated depreciation methods yield a more significant depreciation expense in the early years of an asset's life. Here are some of the benefits of using accelerated depreciation methods. Reduced taxable income. Accelerated depreciation methods allow businesses to claim more significant depreciation deductions in the early years of an asset's life, resulting in lower taxable income and lower tax bills. This can provide a significant cash flow benefit to businesses. Improved cash flow. By claiming more significant depreciation deductions in the early years, businesses can improve their cash flow by deferring taxes and reinvesting the savings in their operations or other assets. Better matching of expenses and revenue. Accelerated depreciation methods can more accurately match the expenses associated with an asset to the revenue generated. This can provide a more accurate representation of the business's financial performance. Encourages investment. Accelerated depreciation methods can incentivize businesses to invest in new assets by providing more significant tax deductions in the early years of an asset's life. This can encourage businesses to replace outdated equipment and improve their operations. Faster write-off of obsolete assets. Accelerated depreciation methods can allow businesses to write off the cost of obsolete assets more quickly, reducing the impact on the business's financial statements and cash flow. It is important to note that while there are benefits to using accelerated depreciation methods, there are also potential drawbacks. These methods can result in lower book values for assets, which can impact financial statements and asset values. Additionally, accelerated depreciation methods can limit the depreciation claimed in later years, potentially resulting in higher taxes. As with any financial decision, it is crucial to weigh the benefits and drawbacks of accelerated depreciation methods and consult with financial professionals before making any decisions. Classification of investments. Investments can be classified into several categories based on their purpose, duration, and accounting treatment. Here are some standard classifications of investments. Held to maturity, or HTM, securities are investments a company intends to hold until maturity. HTM securities are accounted for at amortized cost, and the financial statements do not recognize any unrealized gains or losses. Trading securities, these are investments bought and held primarily to sell soon. Trading securities are accounted for at their fair value, and any unrealized gains or losses are recognized in the income statement. Available for sale, or AFS, securities, these investments are not classified as either HTM or trading securities. AFS securities are accounted for at their fair value, and any unrealized gains or losses are recognized in other comprehensive income, OCI, until the securities are sold or impaired, at which point the accumulated OCI is recognized in the income statement. Equity method investments are investments in which an investor has significant influence over the investee but does not control. Equity method investments are accounted for using the equity method, where the investor records its share of the investee's net income or loss on its income statement. Consolidated investments, these are investments in which an investor controls the investee. Consolidated investments are accounted for using the consolidation method, where the financial statements of the investor and investee are combined as if they were one entity. The classification of an investment is vital because it determines how the investment is accounted for and how any gains or losses are recognized in the financial statements.